Today's Wednesday, December the 9th, 2020. Wanted to do a quick video follow-up here on our video that's gotten a lot of good responses and feedback, and that is our video on spreads, how to choose the proper spread width, and the mathematical calculations that go along with that. And one of the things that I mentioned in that video was that I purposely left out the conversation on delta, because I believe that delta is, number one, important enough to sort of deserve its own standalone video. And number two, it's one of the components of structuring a trade, picking strike prices, that is probably the most misunderstood. In fact, I would say it's not misunderstood. I would say that it is completely misunderstood. It is actually used in the opposite way that it was intended. And I just want to grab a stock here that I think will illustrate that point. This is Amazon. It's ticker symbol AMZN. And if we were to go to our table here, I've grabbed a random expiration date here. This is December 18th. This would be 9 days out. If we go to our options table, you guys know that most of your columns in most brokerage accounts are configurable, and you can go look at whatever item that you would like. And one of the ones, of course, that we are talking about here right now is delta. And delta does a lot of things. We talk about delta dollars and just how that would equate to maybe owning a specific number of shares of stock. If we are in a negative delta, that would be like we have shorted those many shares of stock. If we're in a positive delta, it would be equivalent to owning those many shares of stock. And so it gives us a little bit of directional bias. But of course, we also know that delta is a big part of that POP calculation, that probability of success. So if we look at Amazon here on this December 18th expiration date, and we see this brown bar right here, and that's giving us right here, you can see it goes all the way down to about 29.70 or so, and it comes all the way up here to about 32.40. This is Amazon's expected trading range over the next 9 days. Where does that number come from? Well, it's got standard deviations and all kinds of mathematical calculations in it, but essentially it is derived from these probabilities, these deltas. This is an inverse number. It tells us what the likelihood or what the probability of a stock coming down and touching one of these levels are. And we have one standard deviation moves in here. We have two standard deviation moves right there. And those are all reflective of the delta of a trade. And so, as you probably know, and as you probably understand, if we were to, let's take a look here at Amazon for just a second, and let's just make a quick, simple assumption here. I'm not saying that this is the right way to even trade Amazon right now, but let's say that we feel like Amazon has had this little pullback here and it's bottomed out. It's got some support down here. We don't feel like it's going to go any lower, and so we'd like to sell a put credit spread. Okay, so we could come in here on Amazon and we could look at those and we could say, okay, well, here's the downside range, right? Over the next 9 days, it's expected to have a downside range of about 29.80, 29.70, somewhere in that ballpark. There's your first standard deviation. And here's our deltas. Here's our probabilities, if you will, our inverse probabilities of touching these levels. And so one of the popular trades, especially one of the popular trades with 0 day to expiration trading, is to trade low deltas. Something like even a 5 delta right here, okay? That would, if the inverse of that, you look at the inverse of that, that means it's only a 95% chance. Right there, it's showing 96%. It's rounding. It's basically a 95% probability that over the next 9 days, Amazon will not come down and touch 27.90. So this is a really, really high probability trade, right? And that's why 5 delta trades get put on all the time in 0 day to expiration trading. Now, we know here the numbers on this particular trade. We love the 96%, right? That's the primary reason why 5 delta trades get picked. And so that's a good number. We like that. We don't really like this $30,000, $31,000 of buying power to bring in $450 of profit. And of course, we know if we looked at that in a risk graph that there's undefined risk on the downside, right? So that's some of the reasons that we probably wouldn't trade naked down here. But we could certainly go out $10 and buy back this other leg right here, go long the 2780s, and create a defined risk trade. Now, again, this is a trade. This is an idea that people love to do in 0-day to expiration trading. Why? What's the appeal of this trade? It's right here, guys. It's the probability of profit. And here is the secret. If you can get this into your head, if you can understand this, you will forever change the way you trade, and you will greatly enhance the safety of your trades. How do you enhance the safety of your trades? You increase the delta. You increase the delta. I would submit to you that a 5 delta trade is about as risky a trade as you can possibly make. Now you say, well, wait a minute, it's got a 96% probability of success. Here's the key. Here's the secret to understand. Where is your focus in the trade? It's on one of two things. It's either going to be on probability of success, POP, or it's going to be on the risk-reward ratio. How much are you risking for any potential reward? Guys, the key to success, forget about probabilities of profit. Forget about POP. Paul Tudor Jones, some of the most successful traders to ever have walked the face of the earth are 35 to 40% POP traders. Let me say that again. Some of the most successful traders in the world are 40% traders. 6 out of every 10 trades they touch lose money. See, it's not about POP, folks. It is about establishing a good risk-reward ratio. And the risk-reward ratio here in a 5 delta trade is absolutely horrible. It's absolutely horrible. Now you say, well, wait a minute. Let's just look at some numbers here. It is a 96% probability of success trade. I'm putting up $982 to bring in $18 of profit. Now I know I'm going to have a commission in there as well, so it's really more like $16 of profit. So, you know, that's like 1.6% in a 9-day window, right? That's what, about 4 or 5% a month, 60% a year. That's still a 60% a year annualized potential rate of return. Looks like I'm just getting pennies on the dollar, but it sure seems like it still would be a good trade, right? Well, let's take a look at this trade in the risk graph, and let's look at some of the challenges that we would face in this trade. Again, it's not just the fact, as you can see there on our profit and loss on expiration, that we're going to be bringing in $18. Never mind the fact that it's not really 18, right? It's going to be 16 after our fee and commission there. So we're bringing in $16. Here's the challenge. At expiration, you can see that we're risking a loss of $982 versus a profit of $18. Now, there's a couple of lines here that we're looking at. There's this line right here, and that is at expiration date. And then there's this orange line right through here, which is our theoretical profit or loss on that specific day. Now, we would probably never, we always like to look at this line, right? We look at the line at expiration, but we would probably not be holding this all the way down here. In fact, where would we probably feel comfortable getting out of this trade? Well, generally speaking, and again, we would have to juxtapose this trade against an offsetting trade. We only have one leg of the trade in, right? We only have the puts in. We don't have calls in here showing us a credit or anything like that. And so there are some mitigating circumstances here, but generally speaking, we want to start exiting our trades when we get to a 3 times loss. 3 times loss of our credit, right? Our credit was $18. Well, where does that start happening at? Guys, look at that trade right off the bat. I don't know if you can see those numbers there on the theoretical profit and loss. You will open this trade. This trade will open at a 2 times loss. The very second you open this trade, you're down 200% on your trade because there's such little credit there to offset that. You're bringing in $18, but you're already down $31 right off the bat. If it moves at all, now you're down $61 on an $18. You're already out of this trade right here. Guys, Amazon moves $150 a day. So the trade that you just put on here that's a 96% probability of success trade, to me is a 0% probability of success trade. Are you telling me you're going to let it get all the way? Well, we're in profits. We're in profits all the way down to here, right? So at 2,900, now you're down $254 against your $18 profit. Well, what is that now? A 13, 14 times, a 1,400% loss? Guys, you're not going to hold it all the way down here because the risk-reward ratio on this trade is non-existent. It's absolutely horrible. More to the point, it's not adjustable. It's not adjustable. How do you adjust this trade? There's 18 cents in the trade. How do you adjust it? So here's the challenge with lower delta trades. You're looking at a higher probability of success, but you don't understand that you actually have taken on a higher risk. You have a higher risk trade. You have lower theta decay. The lower the delta, the slower your theta will decay. So the riskier the trade becomes. With 18 cents credit on this trade, it's not adjustable. You can't adjust a trade that has 18 cents in it. Just doesn't give you enough room. And last but certainly not least, the only way these numbers work, the only way this trade works is if you have a 100% capture rate. This trade has to expire. It has to expire fully profitable. You have to let this run to expiration and hope that you stay above that 27.90 number. You've got to do that because you simply cannot afford to exit this trade early. It will wipe out all of your profit potential on that trade. So what happens is very often this trade that you brought in $18 on, you only want to risk 3 times that money, right? So at the very most, maybe you want to risk $60. And you're sitting in this trade down here, not at a loss of $60, at a loss of $244. And you have completely blown your system apart. Now, let's juxtapose that trade, a 5 delta trade, against something that is more of a sweet spot. And folks, I'm going to tell you right now, the sweet spot is a 16 delta. A 16 delta, historically back tested, has been the sweet spot for choosing deltas. Why? Well, we're still risking the same $900, guys. We're still putting up the same $900. You know what? We went down to 82% probability of success. That's not a measurable difference from where we were at. But now we're bringing in $100 of profit instead of $18. Now you see a dramatically different effect here on how that theta erosion takes place. Let's say, again, we're looking at the orange line here. Let's say that we let this go all the way to starting to go into the money. It's starting to go into the money right now, okay? So we've actually let this penetrate below our short call. How much are we down? Look at our profit and loss theoretical number, $400, $398 to be exact. So it's not good. You brought in $100, now you're down $400. That's a lot better than 15 times or 1,500%. 400%, a lot better than 1,500%, right? I would submit to you that the risk is less. It is less in a 16 delta than it is in a 5 delta trade. The higher delta trades, they give you a much better return on the risk that you are taking. They have much faster theta decay. If you want to get your trades green as early in the day as possible, the number one thing you can do to make that happen is raise your delta. That is the number one determinant factor. If you say, I want a trade that has theta that kicks in as soon as possible, what you're asking is to raise your delta. You're looking for a higher delta trade. So just some things to think about, folks, as you are building your trades. A 5 delta trade, even a 10 delta trade, very risky trade, no room to adjust it, and you're going to be having to sit on, you're going to need to be comfortable with a trade that is a 10 delta trade, a 5 delta trade. You're going to need to be comfortable sitting on 5 times, 6 times, 7 times, 8 times, 9 times, 10 times losses until ultimately, hopefully, you expire and you expire in the green, but maybe just right on that line. So this is, again, guys, it's a companion video to the spreads trade video. If you've not watched the spreads training, make sure that you watch that in addition to this. This will hopefully give you some input into how to pick the sweet spot on deltas.